Welcome, everybody. Thank you for joining this hosted event. We're very happy to present our results to you. I have the headlines here and very, very pleased with the team's performance and the company's performance that we've been able to deliver revenue and EBITDA above market expectations and an improved cash position. What drove us to this piece was particular highlights of excellent double-digit growth in Latin America and substantial double-digit growth in South and Southeast Asia. More detail on that to come, but those are the headlines. What helped to improve our cash position was the reduction in inventory levels as we opened a new production plant on budget and on time in November 2022. In our exciting and interesting research pipeline, we've continued to invest in those projects. We have substantial value in those projects, both early stage, medium stage, and late stage. And we will talk about that in a little bit more detail, focusing on the late stage pipeline. And we will also throw more color on that during a capital markets day that we will present to the market in the second half of this year. Dates to be determined, but somewhere around November time. Those are the headlines, and we will move forward, please, Hannah, to the financial details, and Chris Wilks, our CFO, will run us through these.
Great, thank you, David. And it's always pleasing as a finance director, CFO, to be able to announce a market beat. And for those that have followed us, you'll recall that in our pre-close statement in March, we alerted the market to the fact that we expected to be reporting ahead of market expectations at that point. And now we're beating the revised expectations. So very pleasing to be able to say that. And the source of that, clearly the revenue beat was from revenue growth. As an overall group, fairly modest at 4%, but within that, there's some particular call-outs that we will talk to in the next slide or two. China, in the pork industry, in the swine industry, China will always feature. It's half the world's pigs are in China, and therefore it follows that China is a significant part of the group's revenue. Previously, we've reported China component being around about a third of our revenue. Last year, 35%, this year, 31%. So slightly less exposed to China. But we had a very important last half in China, and we'll show you that as we unpick the detail. Outside of China, so addressing the 69% of revenue that's non-China, we saw good growth year on year, 9% up. And you will, if you've studied us at all, you will have noticed that has been a consistent sort of growth rate through all our worldwide markets. Avicen is represented in over 70 markets registered. And so that gives us geographical insulation. We've got the ability to report improvements in some markets while other markets wane, and that can vary year to year, but we do see that consistency of growth as an overall position. So moving on to the next page of financial highlights. Revenue was revenue. We also turned that into an improvement in gross margin, 2 percentage points up, which is directly profit improving, and that flows to EBITDA at 7.2 million, significantly higher than last year at 5.4, and that's a very pleasing thing to see. And it wasn't just in absolute terms that our profitability increased. In margin terms, it increased. So net margin moving up from 6.6 to 8.5. Why is that important? The number change doesn't feel that significant, but it's an important indicator that within this business there is operational gearing, operating leverage, if you want to call it that, meaning you put more revenue on the top line, it flows to the bottom line without too much reduction. That then allowed us to continue our program of new product development. Again, those that have studied us and followed us will know that we kicked off our program in around 2017 with early stage licenses. We brought that through the whole cycle of development from the laboratory into early trials, through the bigger trials, and we're now with our lead products in the final stages of development, which means that we're close to market. We are near to getting regulatory approval, and we, because of that, a large portion of the expenditure was capitalized. Under the accounting rules, you're required to capitalize once you reach a high probability of the successful outcome, and we've been in that stage for the last year and a half. Those earnings turning to an earnings per share of 1.49, which is a nice reversal from the loss per share we had last year. So again, that's an important indicator of profitability and improving profitability. But as every good accountant will say, it's not all about earnings, it's about cash, and three very important cash measures here. Firstly, the overall absolute cash level at March was 21.7 million, significantly higher than last year. That has meant that we haven't drawn on our RCF facility, revolving credit facility of £10 million. That's available, still undrawn, and it's there for investment purposes. And finally, of course, that cash balances come from cash generation from the business, from operations, and that's significantly higher than last year. Reasons for that is largely around working capital unwind. We'll explore that in a couple of slides' time. So moving along into the starting point for P&L analysis, revenues. We see that if you break revenues into two primary segments, China, Japan, which I remind you we said earlier was 31% of our overall, and rest of world, you see that China was relatively flat year on year. We'll have a look at a little bit more in detail in a moment. And we see rest of world growing at that 9% I talked about earlier. For those that don't recall the China story, the 2021 number was something of an anomaly, and the reason for that was associated with a swine pandemic called African swine fever, which swept through the China herd and resulted in a halving of the herd at the worst point in that pandemic, and then a recovery, which was a restocking program, and it was during that restocking period that Avicen found a very strong market. Avicen is a product which is considered to be a premium product, considered to have very good efficacy, and so therefore, if you're in a market where your pigs have high value, you will tend to reach for Avicen to keep those animals healthy and to treat any disease outbreaks. So that was 2021 story. Taking that out of the picture, you can see that China's been a relatively constant market through the last 5 years. Move on to a little bit more detail around rest of world now. And I'll ask David to comment on this.
Thank you, Chris. A couple of highlights to pick out here is the high-performing regions of South and Southeast Asia and Latin America. You see here evidence of consistent and robust growth in Latin America. What's driving that is particularly two markets of Mexico and Brazil, the two largest. And we're making progress there by our efficiencies of operation, by connecting with the customers and demonstrating the value of Avicen and our portfolio. And that is showing the results of around about 15% growth in this year that we're reporting. South and Southeast Asia driven particularly by excellent performance in Thailand in pigs and in poultry in India, both substantial markets, and also benefits in some neighboring countries to Thailand. China and Japan, we've already talked about, except perhaps to note that in China, the smaller component of that, we became market leader in our segment this year, which was nice to see, with a market share of north of 21%. North America showed a little bit of a turning, of flattening in this year. A couple of things driving that. is timing and market conditions. The timing effect was related to inventory levels. There was higher levels of inventory that we sold out in March 2022 and a reduction in channel inventory in 2023. So that's the timing effect. Small add-on there. In this quarter that we are in now, we've seen good trading in the US, which evidences that inventory element is not indicative of share loss or lack of penetration. And the other component is somewhat adverse pork pricing in the US as well. But I think the bigger component is timing. Europe is a smaller component of our business and is trading somewhat sideways in the last 3 years. Somewhat expectation for that to improve this year. One of the things that restrained our European performance this year was changes in method of use. So it was moving away from in-feed to water-soluble. We had expected that might have been accommodated in key markets such as Spain a little bit sooner, but we expect that now that's come back into, they've worked out how to use it, they've worked through their inventory levels, and that looks, that market of Spain looks positioned to grow for this coming year, and that's a very significant component of Europe. So there's some future potential in Europe yet. Rest of world and UK is rather small, so we can move on to the half year analysis. And I'll just start some comments of just focus your attention here on the yellow bars. The yellow bars show the half one of this last financial year, so March to September 2023, and then September, 2022 to March 2023 in the light yellow bar. And you see H2 performance is substantially better than H1. That's typical. That is market conditions. That's because of avolicin's particular use in respiratory disease, which are, of course, more frequent in the winter months. But also to pick out, you can see evidence of recovery in China there, as H2 2023 was higher than H2 2022. So that's quite nice. So you look at H1 versus H2 and look at H2 last year versus H2 this year. We generally see some nice growth and some good seasonal performance and good revenue performance there.
And I think, you know, obviously you can easily associate winter respiratory disease with the Northern Hemisphere, which is a lot of these markets. You might ask, well, why in South and Southeast Asia is it showing the same effect? And that's simply about growth. Those markets, those countries we're talking about are growing period on period, and so hence the reason why the bars go up from left to right.
Next slide, I think.
Yeah, thank you very much. That's
Thank you.
great. Of course, revenue is vanity. Let's get into some sanity, profit impact, and starting off with gross margin. Historically, the gross margin for the group has been mostly impacted by mix, and it's mix of markets that we're in. We've stated before that some of our higher margin markets, and here I'll say countries like Canada and China, the margins in those markets are approaching 60%, versus some of the lowest margin markets where it's much more price sensitive around Latin America, where the margins can be half of that in Canada and China. So clearly, the component of those particular markets in the overall total will tend to move the group margin, and that was certainly true and evidential right up to 2022. 2023, that was there, but there was also an FX impact. If you looked or studied or followed any of the currency markets, you will have noted the weakness of sterling through the year we're reporting, compared with the US dollar and compared with the RMB, Chinese currency, and so that clearly has benefited revenues and in turn gross margin. But off the bat, I'll tell you that you have the converse effect when you talk about foreign denominated costs. So you know, the reverse, it reverses out and hedges that position when you get to net profit. The other comment to make with regard to gross margins is that we have used these inflationary times to push through some sales price increases in most of our markets. And we've done it for 2 years on the trot. First time in January 2022, or at least the early part of 2022, we'll push through a further one in January 23. You have to be sensitive to the price competitiveness and the challenges you have in specific markets, but we've been quite precise in trying to price up to the resistance point. What does that mean in a quantum? We say that in 2023, on average, our prices went up between 3 and 3.5%. Couple that with some good news on API. API stands for active pharmaceutical ingredients. It is the key raw material that goes into Avicen, the pharmaceutical, and it's a significant cost. Roughly, rule of thumb, you can say that a third of revenue is API cost, or 2/3 of our cost of goods, and therefore you can see that the overall cost of manufacture is highly dependent on the cost of that API. We managed to convince and negotiate with our manufacturer of the API a $3 per kilogram active reduction from January 2023, covering this calendar year, and that translates into something like a 2.8% reduction in cost of manufacturing. Of course, there were other cost increases, so it wasn't all good news. In some of our contract manufacturing organizations, our manufacturing houses, they have pushed through costs of often increases of up to 10%. So there's a blended story there, but overall, those pieces go together to be able to say that really our margins are well supported by the actions we've taken. Hannah, moving on to R&D. So we've dealt with revenue, dealt with gross margins, and now we're into investment activity. And you will have noticed in the past we've been fairly heavy in terms of R&D expenditure. It's averaged around 10% of revenue, some years higher, some years lower. The actual amount where that ratio falls in a given year will depend upon phasing of programs, phasing of trials. These trials will often last 6 to 9 months, so they can overlap year to year, and naturally, therefore, you get a variance to that ratio. The ratio, the percentage of spend compared with revenue, is not a hard and fast rule. It's guidance, and it's guidance because it's a useful tool to be able to determine the affordability of the program. We want this to be self-financed from cash generated from the business, and so that's why we use the sort of general guidance of 10%. It's a big number, and that will give us sufficient budget to progress our pipeline of new product ideas from early stage right through to commercialization. The other picture you see on this graph is the proportion which is expensed to the P&L, dark green, and that proportion which is capitalized in the balance sheet in light green. Capitalization of R&D expenditure is governed quite closely and quite rigorously by an accounting standard, and that accounting standard requires that you can only capitalize when you get to an overall position of high confidence that you will have a successful outcome to a development program. In other words, you will end up with a product which is profitable and generates a return on the expenditure in excess of the level of expenditure. So by applying the standards required by that, you can immediately see that there's an implied confidence level around the programs. Now, that accounting standards requires you to capitalize it. It's not optional. If you meet the standards, you have to capitalize. The progression or the trend over the 5 years also tells a story. So 2019 and 2020, where the capitalization proportion was high, represented the tail end of activity on avlacin. Avlacin was a molecule, a new product which was first commenced, the program of delivery was commenced sort of 20 odd years ago. And since that time, since the first license we received on that, we've extended the label to cover more and more diseases. And we've extended it worldwide into more geographies so that we're now licensed in over 70 countries. And that is, it has been a continuum right up to 2020. In 2021, there was very little spent in that area. And most expenditure was on our new pipeline of vaccines. Here we'll talk vaccines as a shorthand, but it covers a whole raft of potential new products, which are in the preventative space, prevention of disease, rather than avlacin, which is treatment of disease. And so 2021 was the sort of expenditure on early and mid-stage projects. And as we got into 2022, the first of those moved over through the stage gate into the final development phase, which is when the capitalization started. And in 2023, a third of our expenditure was on 2 lead products, which are vaccines for poultry, dealing with a disease complex called mycoplasma. And so that really tells you how far along the pipeline we are and how close to market we are. Our guidance for the market for 2024 is that ratio of 1/3 capitalized, 2/3 expensed, which we've seen in 2023, will reverse and become the opposite for 2024. So where 2/3 of our expenditure in 2024 will be on the balance sheet, 1/3 expensed, telling you how close we are getting to capitalized, to commercialization. So if we move along to the next slide, Hannah, please, we'll now look at the rest of the P&L, the cost side of it. Yes, there was an increase in administrative expenses. The breakout of what caused that, I talked about FX effect on gross margin. The opposite of that, of course, is that the costs we have, the overheads we have in overseas operations, they are in sterling terms more expensive because that FX effect, one offsetting the other. So that was more or less half of that increase. We got back to traveling post-COVID, had a full year of getting out, much overdue visits here, there, and everywhere. And of course, that had an impact in cost, about £500,000 due to that. We're now living in inflationary times, and so clearly we had some wage inflation coming through. And we took the opportunity to look very closely at the balance sheet and make sure that all the assets were properly covered by appropriate provisioning. And so that was the other impact we had coming through into the P&L there. So moving along to the final piece on the P&L, which is how does that bridge across from one year to the next in terms of profitability, and giving you a sense of the relative scale of impact. The impact on improved profitability from the increase in revenue is relatively modest. Bigger impact from 2 percentage growth points in gross margin, but offset by the increase in costs. FX was the major player in that, and you can see therefore the offset. Less R&D expense, meaning more of it capitalized, and that benefited the P&L, the bottom line. And finally, there was an element of foreign exchange gain from the crystallization of gains on cash principally, and that was there as a small item. So we bridge across from last year's profitability to this. And for comparative purposes, previous years are in there. You see a much bigger swing in those components in prior years, as we had that China effect, that anomalous year, if you don't mind me calling it such. So moving along now to the balance sheet. Thank you, Hannah. The very obvious items here on this balance sheet are around working capital, and straight away the cash balance jumps off the page at you, being so much higher than last year. And why is that? Well, you can see the reduction in inventory, moving from 30 million last year, last balance sheet, to 22 million this year. That 8 million really flows straight into cash, and we'll see that on the cash flow statement on the next slide. And representing that as the ratio, stock days, it's a fairly crude measure because the calculation is really made on the basis of an average of annual cost of goods. But it gives you a good indication that the 233 we had last year reduced to 174 this year shows you that notwithstanding an increase in activity, the inventory came down. Is there more to go at? I would say probably yes. In this 5-year comparative period that we're showing here, for the first 3 years, we were at or below 20 million. Could we get back to that 20 million level? Yes, quite probably so. And so there's probably a 2 million opportunity in that figure. I think as we go through this year and next, that's when we'll see that opportunity come to fruition. We are one of the projects we've got in action this year, in the year ended March 24, is a new implementation of a new ERP system governing our the initial phase is the UK business, and then it will be rolled out worldwide. The importance of that is that will have full resource planning capabilities. So we'll be able to use that tool to much more accurately predict requirements, reorder points, manufacturing points, and constrictions in order to be able to get the right stock at the right place at the right time. Trade receivables is the other large component of working capital, and very pleased to be able to report a pretty consistent debtor days calculation. Debtor days being a measure of how much receivables you've got by reference to your revenue, and it's quite long. 111 days in absolute terms is quite long and exceeds normal trading terms, but it hasn't worsened, and that is a key point, and it's as strong as it's been at any point in the last 5 years. Which, when you consider where the growth is coming from, so places like the Far East, India, these are countries where traditionally one would assume quite a long debtor book, quite a lot of difficulty with cash collection. We're not seeing that. We're managing that very well. And to give you a sense of why that is, first of all, the nature of our customers are that, by and large, they are distributors. So it's a business partner rather than just a buy-sell operation. And those business partners clearly rely on us very heavily for technical support, for inventory, and we rely on them for being the mouthpiece to the market, and they take the inventory risk and the receivables risk. So it's a very close relationship, and clearly under those circumstances you rarely see a bad debt or a particularly long debt. So that's really the working capital story. We'll see more of that as we move on to the next slide on cash. But before we leave that slide, I'll just make one little clarifying comment around the litigation box, which is at the bottom there, just in case anybody is concerned to see that. This was an issue that arose last year. It was provided for last year at £500,000. no change to the provision this year, and the change in that figure year to year was about the overseas tax liability changing. So that's what that is, just by way of clarification. So moving on to the cash flow statement now, Hannah, thank you very much. Seen through the lens of cash, all those stories on the balance sheet are self-evident. The unwind of inventory, £7.8 million, very little impact from receivables change. And then the China factory, which was the reason for carrying high stock at the end of March 2022, we knew we were looking at a 6-month shutdown in factory. We knew we needed to cover that, and that was why we held 30 million of inventory. That was successfully completed in November last year, on time, on budget, and so you see the capital cost of that going through in this cash flow statement, generating a balance of 21.7 million pounds in cash at the end of the year, a high point in this 5-year run-up. So I think now moving along, we move into more interesting subjects.
So thank you, Chris. So what are we doing in ESG, environmental, societal governance agenda? We've progressed our agenda quite well this year. We've stated what our neutrality targets are. We've stated that we're going to focus more on the E and the S, the G being under good control, and has been a focus for the business over past years. So we're going to focus on the E and the S. One of our major energy absorbers are offices and the active ingredient, and we made great progress there. On our active ingredient manufacturer, they have managed to reduce their energy consumption by 40% over 2 years, primarily by supplying the energy by solar and a little bit of biogas. And by rationalization of our offices and the future sale of one that is progressing, we can reduce our CO2 emissions quite substantially in the UK, and the balance of the offices in the UK will be completely green energy supplied by next calendar year. This is a brief summary of our ESG. We are publishing for the first time. We will publish a sustainability report that's just being finalized, and that will be available on our website. And as far as team and our personnel agenda, as part of S, we did for the first time a internal engagement survey around the company this year, and that provided some very good positive engagement scores that you can see on the right there. So people understand what they need to do within the business. They enjoy working for ECO. They feel that we've got a good purpose. They like the flexibility and autonomy that a flexible small company can give. There's some scores that weren't quite so high, for example, around how we communicate between teams, perhaps a function of remote working, perhaps a function of needing to improve our inter-team communication. That's just one example of one area that's given us direction where we can seek areas for improvement. So that's our ESG agenda. On to the next slide. I think we've covered this largely. This is just a double zoom on China. The first half was crimped by zero COVID policy and market conditions. That improved in H2, as we said. In fact, there was very substantial improvement, 41% H2 versus H1. That was really driven by disease and Avelson's preferred position in being able to manage complex respiratory disease and an aid in the producer's armory against these complex diseases. We've already mentioned the plant, so thank you. Moving on to R&D, which is this is our future. We've made great progress in this. And I'm evidencing that in a number of ways. One evidence is that we've got to the stage where we need to ensure that we have manufacturing capability for our future vaccines that are proximate, and we've secured that by a new and better EU facility. We had an arrangement with a CMO in the US that we terminated, moved to a better facility. It's better, we can rely upon it more, and there's some other benefits as well. Greater certainty and flexibility, I think, there. We're progressing in the regulatory stage of our 2 late-stage poultry vaccines. That we're doing that on a chapter-by-chapter basis, submitting those chapters to the USDA. They have asked us for some additional studies, for example, in pheasants, and we're addressing that right now. And we expect final regulatory submission, which is the last hurdle before commercialization, to be very soon, at least by 2024. That's the near-term pipeline. We also have a really nicely balanced pipeline of early stage assets and medium stage assets, particularly the medium stage assets in the swine arena, against significantly economically damaging and important diseases for swine. That's in our midterm pipeline, and we've seen good scientific progress with those. And all in all, we've got at least 9 products expected to reach US and EU approval in the next planning horizon of 5 to 6 years. One good thing about the US is that you get license in the US. Canada comes kind of as an automatic, and it also allows you access to many Latin American and Southeast Asian markets without much additional work, just some administrative work, regulatory submission, no necessity always for additional clinical studies. Some areas like Brazil, you do need to do additional clinical studies, but access to the US market gives you access to other markets subsequently. We also filled our pipeline in this last year with some really exciting early stage opportunities with Imperial College and Moredun. These are globally recognized, globally important research institutes. And the one with Imperial College was a vaccine platform. Interestingly, AstraZeneca picked this up for use in human medicine, and we picked it up for use in veterinary species. So all in all, our pipeline is really nicely balanced across opportunities, early, mid, and late stage opportunities, and nicely balanced across geographies that are important to us. We expect to do a capital markets day in the second half, as I mentioned earlier. And that brings us to the summary. So the good news that we're reporting now of beating revenue and expectations in the market, and EBITDA showing a clean set of results. The good news, that strong start has continued from the second half of last year that ended in March into this quarter, March to June, and that strong start has continued. China is ahead of last year, and the consistency and robust growth in South and Southeast Asia and LatAm, that continues to happen. I mentioned EU and the US in our biological future. We have also signed a memorandum of understanding with a biological production entity in China. That's important because that allows us to have a footprint in China, and we will produce vaccines and biologicals in China for China. And that's another evidence of how we're progressing the agenda along by finding and signing an MOU with one of those partners. In the US, also very recently, we received an FDA notification that that Avlacin is now labeled for use in pregnant and lactating sows. That wasn't on the label before. It is now on the label. That will allow us a particular additional access where treatment of pregnant, lactating or breeding sows and replacement gilts is required. So it takes away a barrier. It's a permissive to further usage of Avlacin. So you wrap that all up. The summary is that very pleased to report these results. They're a good set of results, and the trading momentum has continued to progress from the second half of this year, when we're reporting into this current financial year. And with that, Hannah, thank you for advancing the slides, and we are open to any questions that there may be.
Dividends. You've obviously met expectations, but at the moment, no comment on dividend and the company's policy going forward. Would you like to elaborate at this point?
Yeah, I think this is something which we keep under constant review. Clearly, there's value to paying dividends, and that doesn't pass us by. On the other hand, we need to be cognizant of our cash, and we make a lot of, and we don't make excuses for describing the value that we believe we are creating in this R&D program. And the expenditure of £8 to 10 million a year, that cash needs to be found, and it is cash that needs to be found in the UK, not in China. So it's a balance. We believe the best use of the company's cash and cash resources is in the furtherance of that R&D program, bringing forward new class-leading products, which will accelerate the growth and make the company more efficient in terms of use of its regulatory structure. So that was certainly the decision this year. It's not a forever decision, and that is a decision which every year the board considers and takes the view.
Okay, thank you. Perhaps slightly different question on dividends. What is your current guidance around dividends to be received this current full year from the wholly owned subsidiary in China? I was pleasantly surprised that the dividend was 4 million. Should I have been?
Pleasantly surprised. Good. Yes, we received that, and we received it before we've announced these results. So this is the dividends related to last year, because the dividends always lock back to the profitability of the previous financial year. And historically, those dividends have sort of dribbled through in the autumn months. So you can see the improvement in that whole repatriation of cash to the UK. Is that a level of cash that one would expect to come out each year from China? I would say yes. So pleasant surprises may continue.
Yeah, and we've established a pattern of doing it, and that's evidenced by the regularity and the advance of the receipt of the dividend in this period.
Thank you. In the past annual reports, you've stated that a 10% move in the renminbi FX rate, pound rate produces an effect of 2.9 million. What current guidance are you giving on this, given changes in this FX rate in recent weeks?
So the guidance we're giving right now is that if you look at the US dollar, the P&L is pretty well hedged. The dollar we generate from revenues is offset by dollar-based cost of goods, and in particular, the API that we buy worldwide is a dollar-based purchase. So that goes a long way to offsetting the revenues. Add in the dollar-based overheads we have and the R&D expenditure, a large proportion of which is in US dollars, you get to a pretty nil position at the end. So movements on the US dollar to sterling are naturally hedged across the P&L. The RMB absolutely is an RMB based P&L, and when consolidating that into a UK sterling home currency, of course, the sterling to RMB exchange rate does have an impact. To give you an idea of the impact in this last year, it's about £200,000 benefit to the bottom line of the movement in the pound versus RMB. There's a weakness in sterling.
One for you, perhaps, David. This investor's understanding is that last year you got a new approval for Avlacin in China for egg-laying poultry. Is this correct, and how have sales performed?
That is correct. Last year, we received approval for Avlacin usage right the way through the egg-laying hen's life with a zero egg withdrawal. Excuse me, with a zero egg withdrawal. Without diving too much into the detail, there was another approval that we needed to seek and teach the market. So I think the short answer to your question is we have made some progress there, but there's more to be made in this year because we're better geared up to do that this year. We didn't quite have all the tools that we needed last year. So I think some of that upside is not been fully executed yet. And I think there is opportunity in poultry in China that we have a much larger proportion of sales into swine, and this new egg laying or relatively new egg laying approval in hens does give an opportunity to dialogue with those customers, and there's more to be done there. So future opportunity as well as last year opportunity.
Okay, thank you. How long do you expect it to take to get regulatory approval for the two late-stage developments, considering that approval process for human health in the UK is currently a little slow?
It may be a little slow. I'll draw the parallel. So our regulatory authority in the US is the USDA, not the UK Medicines Authority, nor the EMEA, and the FDA and those other ones that are often used in human medicine have a certain amount of delay in them and a lot of congestion. And it's absolutely fair to say that the USDA is a shorter pathway and a more straightforward regulatory pathway. We know exactly what we need to do and the timelines. What we've said is that between final submission and approval is 6 months is what we factor, and that's a well-evidenced sort of length of time, not just for us, but for, it's a market relevant sort of period. So that's what we're factoring from final submission. Leads to a question of when will we do final submission? Well, in the presentation we said we should be doing that next year. So first meaningful revenues coming from the commercialization will be in financial year 25. So in 24 will give us submission and approval, everything according to our planning, and therefore commercial sales in 25.
Thank you. Can you confirm that consolidated gross cash in China was 17.6 million at the year end?
Correct.
Thank you. The reduction of exposure to China, Japan was on purpose due to a policy focusing on other countries with higher margins. Is this the case, or have you lost some clients?
Not exactly. No, it's not policy. Just a little bit of background mentioned earlier, our global presence and our sales in multiple geographies allows us to balance where the opportunity is. We found greater opportunities, market-based greater opportunities in Latin America and South and South Asia than we have in China. It's not that we're withdrawing from China or actively taking focus away there. There's just been better growth opportunities in other parts of the world. We have adjusted our approach in China to a certain extent to focus on segments that are more open to us, and that is what has supported the sales growth that we mentioned in the second half. So no policy to remove it. We're just finding the opportunities globally where they are most accessible to us.
Okay, thank you. And I suppose that as sort of a follow-on, has your view on the political risk of your operations in China changed in the past year?
Well, I would say I'd answer it this way. We are hedged around the world by our global presence. Do we want to be in China? Yes. It's a substantial market, and if we're not there, it will be deleterious and inappropriate and poor strategy. Of course, we take into account the complexity of doing business wherever we do business. But I wouldn't say that we found it a changed environment from a political standpoint in this last year. And in fact, we found more access and more capability to execute our commercial activity as the zero COVID policy came off in sort of January of this calendar year. Okay, and then again, leading on, obviously, as you've tried to diversify into new regions and increase global presence, can you elaborate on the development of number of clients in these regions, and are your end markets becoming more consolidated, i.e. bigger but fewer clients? Yes, that latter piece is accurate. There is generally a consolidation. So there are more pigs, but held by less ownership hands. That has some benefits of access because there's fewer clients, fewer key accounts to attend to, but it also brings more attention that one needs to pay to these bigger accounts. So it is much more in that direction. And for the first part of the question, in terms of numbers, the numbers have gone down, but there is still definitely growth in the market. There's growth for penetration of our products in the market. There is fundamental growth in some of the geographies that we said. The demographics of the human population give us growth, meaning there's more people in the world, and more people in the world need good quality protein. That's where we fit in the food supply, helping chicken and swine producers produce high quality needed white meat, and so that growth driver, the demographic growth driver, is intact. A little bit of a look back here. Could you elaborate on the 5-year historical development in market share for Avlacin, and what's the latest for Zoetis and Elanco in terms of what's the latest from them in terms of competition? Competition framework from those and the other majors in the animal health has not changed very substantially. We compete against the branded products, the likes of Thailand, the likes of Duraxin to some extent, Lincospectin, these products. Not a huge change in that in our direct competitors. So that's been pretty consistent. In our market share, we've seen, I mentioned that we continue to take share and improve penetration. That's what has driven the revenue, allows us to do that. And a couple of headlines there that I think I mentioned. So we became market leader in Japan with a market share of 21, or just a little north of 21% in our segment. We're also market leader in high margin areas such as China. And our market share, I think, has increased in most of the geographies that we're talking about, and in all of the geographies where we've showed growth.
Thank you. What are your thoughts on in-house R&D versus bolt-on acquisitions?
We like the potential of both. We are focused on on internal. When we say internal, perhaps a brief how does it work within ECO? We have a range of talented scientists that manage the programs, but the lab work is done in contract research organizations. That's a relatively lower cost, lower capital deployment that allows us to be flexible. So we like that piece of what's called, in inverted commas, in-house. Would we look at acquisitions, partnerships, those types of things? Not for very early stage or even medium stage, because our pipeline is very comprehensive and it's big. And I think we've got so much innovation. We're pregnant with innovation, and our job is to midwife that innovation to launch. Now, if there was late, at market stage developments, that would potentially be attractive. And I think I'll leave it there. So we like both. We're open to both. We're focused on semi in-house, but we do look around to see what is else out there. But our pipeline is pretty full, so we're more looking at commercial partnership opportunities.
What would you anticipate would happen with China sales if pork prices remain around the 14 renminbi a kilo?
Well, we've been able to trade at this level reasonably successfully. Would we like to see it higher, and would it make the market environment easier? Absolutely. And if I look at some of the futures market, that's what it's calling for towards the second half of this calendar year. So that would be helpful for us, of course. Other point to note, our progress is not a direct line related to, we're not a warrant on the swine price or the pork price. And why is that? Because we are balanced on geography. And for example, Brazil, a big exporter into China, is a big market for us. And as they continue to export, that's helpful for our sales in that geography, just as for example. But yes, of course, it would be helpful if the trading conditions were better everywhere, of course.
Well, I think we're down to our last question. Can you give a little more guidance on market opportunity and how you see late stage products that are in development and pipeline? I guess an opportunity just to expand on perhaps some of the messages we might hear at Capital Markets Day later in the year.
Yeah, more detail at there, but I will give a little summary here. Our two late stage operate in an existing market that's north of $50 million. We aim to bring innovation there in terms of the efficiency of the vaccine, how protective it is, what it actually does in the animal, and also differentiation in the way of how we bring that product, how people use it. So a more easy to use formulation compared to the existing competition. So we will be entering a market that's established. That's helpful, I think. We'll be entering with innovation that we believe will be valued by producers, and that will allow us to take a good slug of that share. 20% or so market share is what our models target at the moment. And so that perhaps gives some evidence. And of course, all of these markets really are growing. The preventative segment of animal health is a growing segment across all species, and in swine and in poultry. Preventative therapies are about high 20% of the total market. So it's a substantial part of the market that we can then access. And it's also a growing part of the market. So and I'll more detail for our mid-stage pipeline. I won't get into that right now, but I hope that provided a little bit of color for our most immediate prospects.
Very helpful. Well, thank you to you both for your time. And we look forward to perhaps, well, I think before your next set of results, it sounds like we'll have the Capital Markets Day. So we look forward to hearing from you both then.
Thank you very much. Thank you for hosting.
Thank you.
Thank you.